Essentially, it's a business which looks amazing from the profit and loss statement.
Right.
30% revenue growth, 40% EBITDA margins, PAT margins of about 25%, order book at 5.5 times last year's revenue.
Right.
But when it comes to the balance sheet and the cash flow, it sort of gets a lot more diluted.
Welcome everybody to Taking Stock. This is a weekly podcast where we talk about, every week we pick one stock, one company and do a deep dive into it. Today we're going into a relatively unknown stock, an unknown company called Deep Industries, which is one of the bigger players or one of the upcoming players in the oil and gas compression industry. Based on the research that I have in front of me, it says that Deep Industries has an 85% market share in gas compression.
Right.
What's gas compression?
The thing with gases and the industrial production of gases is that while it's an extremely viable, profitable business, legitimate use cases and all of that, the pain point is in terms of transportation of gas from one place to another.
Okay.
Like imagine you're making gas and you have to transport it from one place to another.
Right.
It's absolutely pointless to, in gas in its original form, to transport it because it's very inefficient.
Right. And it's costly, I'm assuming.
It's costly.
Extremely
because
costly. Yeah.
Imagine putting it in a tanker and then passing it on. You're just essentially transporting air from one place to another. Right. So it becomes super inefficient. So for storage as well as transportation, what usually makes sense for gases is to compress them or liquefy them.
Okay.
Either of the two.
Okay.
That's why compressed natural gas, liquefied petroleum. Right? So it's always in another form. So that typically, like very basic science is that when you compress something or when you increase the pressure of something, the molecules come closer together. The state of matter changes. From gas, it becomes a liquid, or it becomes more tightly knit so that more molecules fit into that space. Right? So you can transport more.
So is compression done only from the point of view of transporting gases from point A to point B, or are there other purposes to it as well?
It can be for storage as well, because sometimes gases may be unstable at their current state. And probably you want to stabilize them and hence you compress them. Sometimes it's also used for, let's say, in a steel plant, when you want to increase the temperature. You actually compress oxygen and then release that oxygen in so that the oxygen increases the temperature of the furnace. Or for example, in drilling, when you compress some gas and then release it, it actually releases at a very high pressure, actually having the ability to even cut through metal.
So even
if you look at a dentist, right, you've got compressed gas for cleaning your teeth. So it has various forms of
Fair enough. So again, based on the research that I have in front of me, right, it says that first of all, Deep Industries is a company that I had honestly not heard of. It's definitely not a household name from what I gather. But one number that really sort of stands out is that it has recently acquired a 1,400 crore rupee order from ONGC. Now, is this just one massive order for gas compression? Or is it a lot more nuanced than what it's looking out to be?
Yeah. So you're right about 85% market share in natural gas compression. So just to add a little bit of context, while we spoke about the different uses or use cases for gas compression, what Deep is specializing in is doing this for oil and gas sector. So, for example, when you're extracting oil and natural gas from a well that is, say, in the middle of the sea, when you extract that natural gas, drilling of that entire process, as well as when you extracted it, storage as well as transportation, both of those things require it to be compressed. So we're talking about Deep Industries' capability in compressing natural gas for drilling as well as storage. So just sort of carving that out before we move. Now coming to the contract, right? 1,400 crore contract from ONGC is not only for, in fact, it is not for compression at all.
Okay.
Not at all. So what they're doing basically is that they're extending the life of a well that they already have. So just to give you a little bit of a,
It's okay.
Yeah.
People are moving around in our office.
Yeah. So this contract is called it's called a production enhancement contract.
Huh.
Now imagine there is a oil and gas well. ONGC had the well, they drilled through it, they removed all the oil, they removed natural gas. It came to a matured stage.
Right.
Now the effort to remove more oil and gas from it is difficult. So it is not a core objective anymore. So what ONGC has done is it's contracted this entire activity to Deep Industries. So Deep Industries will be carrying out the drilling in this well now, and whatever natural gas they take out of it, they will keep 64% of the revenue from that gas, and the rest will be ONGC's.
Okay.
So basically, they have evolved over time from just being able to compress natural gas to now being able to take a hands-on.
So they're pretty much sort of running the oil rig,
In a way, yeah,
right?
yeah.
Okay. So, I mean, I think to sort of set some context for everybody listening or watching, probably if you can tell us a little bit about what Deep Industry is it, where did it come from? Because the numbers look quite staggering, but it's a company that is not very popular or not very heard of.
Yeah, I mean, that happens with a lot of B2B businesses, right? So just to give you a brief sort of timeline, how it works is 1991 is when the company started. It started with the objective, or with the first contract was for air compression. So basically compressing air, not natural gas. That was the first contract. 3 years later, they went into natural gas compression. That was the second contract. Now, why are oil and gas companies actually letting compression being done by somebody else? That is because they want to focus on the core activity of drilling. Anything that comes around it, whether it is compression, whether it is services, whether it is safety, whether it is anything, there is a lot of factors that go into oil and gas drilling and exploration and stuff like that. That they usually tend to pass on. It just becomes more cost effective and they can focus on their core activities. So that was the whole proposition that Deep came in with. So initially they started with compression. However, then they started getting into something known as workover rigs. Workover rigs.
Workover rigs. Okay.
Like there are drilling rigs, there are workover rigs.
Right.
Workover rigs, essentially, they get into a rig and do the servicing, operational bits, maintenance,
Understood.
changes, repair, etc.
Right.
That is a workover contract.
But they were always a company that was working on an outsourced basis.
Yeah.
So you had companies like an ONGC and sort of multiple others
Reliance
who own
and
these
whatever.
rigs,
Yeah,
right?
yeah.
Would outsource their rig work or whatever else you might call it to a Deep Industry.
Yes.
Fair enough.
So initially it started with a small contract of saying, let's compress air, then natural gas compression, then workover rigs. Then it went into gas dehydration. So for example, once you remove natural gas from the well, when it comes out, there is a lot of water mixed inside it as well.
Right.
Now this is not good because one, is diluting your natural gas. Number two, water also leads to corrosion of the pipelines.
Right.
So you want to dehydrate the entire thing.
Correct.
So these guys started dehydrating the natural gas as well. Then from there, they went on to further going into drilling rig contracts itself. So now they're able to manage entire drilling end to end for anybody. So basically, the point I'm trying to make is that they started with one activity in the entire oil and gas space. But however, I think the founder was pretty visionary in terms of saying that he also named it Deep because he wants to get to the fundamental level of being present in the oil and gas industry.
I was wondering if it's deep or deep.
Yeah. The sun is not called Deep. It is Deep Industries. They wanted to get deep. And that's how they've gotten deep. Right. So just to put some structure to it, because we've thrown a lot of jargons around here.
Right.
To simplify this, the oil and gas industry is basically split into three parts. Right. There is something known as upstream, there is midstream, and there is downstream. Okay. Upstream has to do with exploration and production of oil. So you explore, you find out where there is oil, and you dig and you take out oil. Right. So exploration and production is usually the upstream part. Midstream is where you're transporting and storing. So transportation and storage
somebody
is
entering from downstream, I think. Sorry.
And then after midstream, there is downstream. Downstream is basically refining and marketing.
Right.
So once crude oil comes out, you're breaking it down into parts like petrol, diesel, kerosene, jet fuel, Vaseline,
Understood.
whatever, right? So all those parts, and then distributing it across the city for people to use it, like petrol pumps. Right. Now, Deep Industries is very deeply present in the upstream as well as midstream parts.
Okay.
In upstream, it is doing drilling activity.
Right.
Providing drilling rigs, doing all of that. And in midstream, it is helping in both
Compression.
compression as well as storage.
Right.
Right. So those are the two activities when it comes to the midstream.
Fair enough. So now, when we look at the 1,400 crore order from ONGC that's happened, and is this something that is quite recent?
It is recent. In fact, they started work on this only in April. They must have received the contract, say, last year.
Right.
But there obviously goes a lot of work into such contracts in terms of preparation and setting up and stuff like that. Now, what is expected is that in FY26, this will contribute to about 60 to 70 crores in revenue. After that, it will go to about 120 to 130 crores in FY27. And a majority of the revenue from this contract is expected to come in within the first 10 years.
Right.
And then it will start to taper off.
Fair enough.
Because anyway, the entire objective of this is to enhance the production of an already sort of mature well.
Right.
So from that angle, it will sort of peak for the next 9 years, and then it will start
tapering off.
And because it is a revenue shared contract, the margins in this business can be ridiculous. Ridiculous in the sense, I mean, they're expecting about 50% odd margins.
So that's what I actually wanted to ask you about next, right? Where if you see the 1,400 crore the order book that they've got over the next few years looks impressively strong, right? But what does this mean in terms of the company's growth?
So this company has been able to grow very rapidly and in a very healthy manner because of an expansion of services, right? From one area, as we discussed, to multiple areas now. And this is a whole new revenue stream for them now. So if I have to look at the total...
So sorry to interrupt you, but so you're saying that this is the first of its kind, this 1,400 crore order that they've got from ONGC in terms of the services that they are providing to fulfill this order is a first of its kind for deep industries.
Yeah. So after this order, they actually rejigged how they look at their own business.
Right.
So now the way they look at their entire business is that there is gas processing, where they've got compression and dehydration, those two activities. So that is one segment. Second segment is production enhancement, which is your ONGC contract. And if they're able to get something like this on similar lines in the future as well. Number 3 is integrated project management, which involves drilling as well as the workover services. And number 4 is offshore services. We can touch upon this a little later, but offshore services basically comes from one of the companies they acquired.
Right.
So this contract has been material enough for them to carve out a separate business from it and say that if we do well or if we perform well in this business, maybe we can get some more contracts from similar wells across the globe.
So let's say in terms of the company's growth and the company's numbers going forward, this looks quite impressive, right? The order book looks great. The margins look amazing. How does it stand in terms of profitability?
Yeah. So see, overall, even this contract, if you look at the FY25 base in terms of revenue, it is about 580 crores. On 580 crores, if they're expecting 60 or 70 crores in this year, and then 120 at a steady state after that, it is a material contract. Right. So that is one contributor to growth. The second contributor to growth overall is the fact that these guys, the oil and gas industry itself is a very high growth industry. There is a lot happening there in terms of the market expanding, whether it is in terms of drilling, whether in terms of storage and transportation, or downstream when it comes to disbursement. So all three levels of the oil and gas industry are seeing very high growth. And within that, these guys have been expanding services. So if we look at the next 3 years, on average, consensus estimates by analysts on the street hint towards a 30% CAGR in revenue growth over the next 3 years. So essentially, you see 30% growth, which is very, very healthy. So in fact, if you're at about a 580 crores in FY25, using this rate, you will get to about 1,300 crores by FY28. So that is there. Now, on the margins front, in FY25, these guys did about 40% EBITDA margins. So
which is very good.
It's beautiful. The operating profits are amazing in this business. And the couple of businesses that they have now gotten into, which is your production enhancement as well as offshore services, both of these have above 50% margins. So despite the good margins, I think margins can only inch higher from here.
Okay.
So you'll actually probably come to a place where by FY28, analysts are actually expecting 45% EBITDA margins by then.
Right.
So profitability wise also, this company looks really good. And I think the fundamental to sort of understanding why such a high margin business exists goes back to sort of trying to understand what they exactly do, right? So at a very base level, they've got two options, right? So basically they've got all this equipment.
Correct.
Whether it is for drilling, whether it is for storage, dehydration, it requires massive equipment.
Right.
Gas compressors, which are heavy duty.
I'm assuming extremely capital intensive also to start with.
Yeah. Right? Very high on capital expenditure. So all this equipment, why are oil and gas companies even giving them the contract? Right? It's not only because it is not core for them, but also because instead of buying the equipment, they can just rent it out.
Correct.
Right? And renting in such a case has two options. It's like either you take a car on rent, right, where only the vehicle comes, you are driving it by yourself, nothing else is available with it.
Right.
Or what happens is that you get a driver along with it. Now these guys are tilting towards that driver bit because it's a very professional industry.
Right.
Tomorrow I can have a compressor in my warehouse, and Reliance requires a compressor. I can give them the compressor and say, okay, do it. It doesn't work that way.
Correct. You need professionals to sort of handle that equipment as well.
Yeah. Not only to handle, also to even set up the equipment.
Right.
So even in the drilling process that we're talking about, there is one part which is air drilling. The other part is drilling using mud.
Right.
So there is a whole field called mud engineering.
Right.
Where you determine what kind of mud you use, what pressure, what velocity. Before that, there is something known as coring. Coring is where you actually go down, pick up a piece of rock and get it up.
Right.
You study it. What is the composition of it? What is how porous is it, etc. And then figure it out. So these are very, very technical things.
Correct.
And that's why they come at a high margin.
Right.
So and hence the high profitability. So these guys are present in a business which is not only renting equipment, but is saying that we'll rent it to you, avoid capex for you, and with it also additionally give you services in terms of planning, design, operating, maintaining, servicing, end to end.
Right. No, now I have a little bit of a question here, and I'm sure a lot of the people who are listening and whatever we've spoken about in the last 10-20 minutes, I'm sure there's a lot of people out there who are going like, okay, you know what, everything sounds great. Is this too good to be true? Right? What's the catch?
Yeah, there is a catch here. The catch is where you got it right. It's one of the things you said, which is that the business is extremely capital intensive. One of the reasons why oil and gas companies don't do it themselves is they're like, why do we take on the capital expenditure of it? Anyway, there is so much expense in exploration, etc., and even in the drilling activity. If there is anything we can just get rid of, outages, right? So on average, if you look at the equipment that is required either for drilling, for example, right? This comes in a range. It comes from 350 horsepower machines to 1500 horsepower machines.
Right.
The cost is between 15 to 200 crore.
Okay.
And these guys obviously need to have multiple of those.
Correct.
And if they have multiple of those, you can't assume that they're operational all 365 days.
Of course.
That's one more reason why somebody is not taking the capex by themselves. Because they're not going to use it every day.
Right.
So this is expensive stuff. The rent for it can be anywhere between, if you're only renting it out, 7 to 35 lakh a day.
Right.
If you're chartering it out, which is with the services, it comes to between 10 and 50 lakh a day, depending on
which equipment, what services,
what horsepower and stuff like that. So essentially, whatever investment you're making in order to buy the equipment, assuming it will be rented out every single day,
right,
you will make the money back within 1.5 to 2 years.
Right.
However, that's not going to be the case. Yeah. Right.
So even if it's rented out, let's say 50% of the time, you're then looking at a 4 year,
4 years of payback period. At the same time, what will happen is that customers are not going to immediately pay.
Right.
So what you also got to understand that this sector is very heavily intensive, not only for these guys, but also for the production guys.
Right.
So, and then you're dealing with PSUs.
Correct.
So in that case, what happens is...
Careful.
We should have a warning light somewhere. So one problem with the industry is that there's a lot of capex. So if I look at the balance sheet of these guys, the gross fixed assets come to about 1,000 crores.
Right.
Just to give you context, 570 crores is the revenue. Gross fixed assets are about 1,000 crore. Market cap is about 3,500 crore. So just putting numbers into context, they're not that they have any dependence on each other, but just sort of giving you a sense of the scale. Work in progress is about 200 crores.
Okay.
Right. So very heavy in terms of capital expenditure. Number two, in terms of receivable days. So once I bill you, how many days do I get the revenue back in?
Right.
That number stands at about 370 days. So basically,
so there's one guy for 370 days, sir, invoice has been sent.
Yeah, essentially. So that's the other problem. Third problem, even if you gain the money back after 1 year, right? No problem, give it after 1 year, you start getting your cash flows. You still have to, for growth, invest in the business.
Correct.
Growth does not come for free.
Right.
Because at the end of it, growth is going to be limited to the amount of equipment you have and how well it is utilized.
Right.
In order to grow more, if you're looking at a 30% CAGR, you have to invest more money into buying more equipment.
Right.
So essentially, if I look at the last 5 years, I look at the cumulative cash flow from operations and I subtract the capital expenditure, there's a number that is called free cash flow.
Okay.
Which is a good metric to see in terms of where is the business making money or not.
Right.
Operating profit margin, great, 40%. Free cash flow, they've done a negative over the last 5 years.
Okay.
So they've ended up investing more money than they've actually made. So essentially, it's a business which looks amazing from the profit and loss statement.
Right.
30% revenue growth, 40% EBITDA margins, PAT margins of about 25%, order book at 5.5 times last year's revenue.
Right.
But when it comes to the balance sheet and the cash flow, it sort of gets a lot more diluted.
Correct.
And one other metric to sort of look at is how much ROE or ROC the business makes. Right? Because at the end of it, ROE.
So what's ROE is return on equity? What's ROC?
Yeah, capital employed.
Okay.
So return on equity and return on capital employed also includes capital employed will also include your receivables and working capital basically because that's also capital you're employing in the business.
Fair enough.
Right. Now the ROE in FY25 was 10.5%.
Okay.
ROCE was 13%.
Right.
Now the difference here is that, right, like 40% operating profit margins, but early teens when it comes to return ratios.
Correct.
Which shows you the balance sheet health.
Right.
So while you're right about great business, numbers look so good. I think a lot of analysts usually stop at the profit and loss statement and say, great, let's buy into it because this is beautiful. You come to the balance sheet and cash flow and that's where things start to be a little more complicated.
Right.
Now, I'm not saying it's a bad company. It's a great company. It's just that the nature of business is such that it is capital intensive, that it is heavy in terms of, difficult in terms of getting money back from your clients. And hence, it's going to be a little damped up. So the way to look at it is, rather than saying it's a good business or bad business, depending on this, it's a good business and a good industry. But the implication on the stock is that the valuation hence will be lower.
Understood.
So if it's like this, right? You've got an apartment that's looking at the sea, an apartment that's looking at a slum. There is a difference in terms of pricing.
True.
It's as simple as that.
Right.
So that's a bad analogy, but sure.
No, it makes sense. It makes sense.
So in this case, what happens is that despite the 30% growth that is projected, despite all these contracts that are coming in, if I look at the valuations, this company trades at roughly, I think, 12 times 3 year forward. 15 times 1 year forward and 12 times 2 year forward.
Okay.
Which is pretty inexpensive. It's very cheap valuations, if I must say. Because Nifty 50 itself is trading at a 19-20 times at this point. Right. Just to give you context of how this stacks up. So great business, very cheap margins, but cheap margins also for a reason.
So, okay, that's all for this week. Thanks a lot for listening and encourage us by liking, sharing and subscribing. And stay tuned because we're going to do this every week. Every week there will be a new stock, a new company, and we'll deep dive into it. Thank you so much.
Disclaimer. This content is for informational purposes only. None of the stocks, brands or products mentioned are recommendations or endorsements.